So good morning, everybody, and a very hearty welcome to this executive remuneration webinar. I see executive remuneration remains very interesting and popular. We have had over 400 people registering for the webinar. I see a number of current and prior clients and colleagues. So welcome to everybody who I know, and nice to meet you, those of you whom I don't. So my name is Martin Hopkins. I head the Reward Advisory Services at Bowmans. Unusually, I'm not a lawyer, as many of you know. I'm a mathematician by original training, but have landed up in this practice. I am thankfully backed up by three real lawyers who will help me with a lot of the answers to some of the more tricky legal and tax questions, and I will introduce them shortly. Just firstly, I'd like to just give you a few housekeeping matters, which will hopefully enhance this webinar experience for all of you. So as participants, you are all automatically muted and the chat functionality has been disabled. So if you have any questions during the webinar, please make use of the Q&A tab at the bottom of your screen. Your questions will be submitted to me and I'll select a few to discuss with the panel at an appropriate time during the webinar. Please note, we won't be providing written responses real time to those questions. We'd rather take them verbally. We've also prepared a poll, which will appear on your screen shortly after the webinar commences. It will remain open for about 20 minutes, and the results will be shared anonymously towards the end of the webinar. Please do take a moment to complete it, as it will be interesting for both the panelists and the participants to hear about your respective remuneration experiences. We just want to stress the results are anonymous, even to us as hosts, so please don't let that put you off from participating. Finally, this webinar is being recorded and a copy will be available on our website later today. That is www.bowmanslaw.com. There are also a few other resources that we make reference to in the course of the discussion, and we will also put links to that you can access. So firstly, I would like to introduce my colleagues on the webinar. So just start with Graham.
Morning, everybody. I'm Graham Demant. I'm a senior partner in the employment and benefits practice. I've developed a peculiar and unusual interest in executive remuneration. I think it's largely sparked out of jealousy when I see the figures that Martin has been giving out, but that's me.
Thanks, Graham. Then Helen, if you could introduce yourself.
Hi everyone, I'm Helen Volsenach. I'm also a partner in the employment and employee benefits practice area. Executive remuneration is obviously something that comes up with a lot with our client base, with our multinational and local clients, and it's something that's a very dynamic, evolving area, so great to be on the panel.
Thanks, Helen. And then Kelly.
Morning, everyone. I'm Kelly Wright. I'm a partner in the tax practice here in Johannesburg, but I have a particular interest in structuring employee share incentive schemes. So I work a lot with Martin, and I design and help implement a number of different types of share incentive schemes, both for listed and unlisted clients.
Thanks very much, colleagues, and I'll pull them in when we get to some specific employment law and tax matters. But let me kick off. I think given the ubiquitous nature of the COVID-19 issues, let's start off with that. Although I promise we will move on to some other issues as well. So I think maybe just to summarize what I'm seeing, and certainly seeing from a lot that's written and a lot of the surveys that are being done in terms of the basic elements of remuneration, and that will also obviously kick off into some of the topical legal and tax areas. So as usual, like any reward person, I will split that up into the usual elements of reward. So we'll start with base salary, specifically looking at some of the adjustments and pay cuts to base salary. Then move on to increases. Are they being implemented? What are people doing about multi-year wage agreements that are in flight? About those that have to be renegotiated? What's happening there? We'll also have a look at benefits. just in terms of, is there anything you can do there to give people a bit of cash in their pocket whilst not really prejudicing some of the very important risk and health benefits, which are becoming even more topical with the risks we face. And then also in terms of short-term incentives, what is happening in terms of this year's bonuses, which are in flight, and what is happening about future short-term incentive targets in this time of massive uncertainty and a lot of financial distress. And then my personal favorite, long-term incentives, three aspects really. What's happening in terms of what I call in-flight awards. So those are all the awards which have been made in 2017, 2018, 2019, etc. They're in flight, they have existing performance conditions or strike prices. They're coming into roost and to vest shortly. Is there anything one can do about that? Also, what is one doing about future performance conditions? And should one, given the specific stresses of the moment, take a step back and even look at the entire remuneration paradigm? And are there some interesting things one can do there? So just to start the ball rolling in terms of what we're seeing in terms of the COVID-19 responses, we've all seen the base salary cuts that have been the high-profile base salary cuts that the chief executives and other executives of several of our very large companies have done, and those have either been donated to the Solidarity Fund or have been kept in the business to try and make sure there's enough cash to pay the ordinary employees as well. And I think those have been done primarily to show solidarity with the stress and suffering of many people, and in some smaller organizations also genuinely save some money. When you've got 3 executives and you've got 40,000 employees, it's not much of a cash saving element, it's more a solidarity element. So two things to discuss there. So the first thing is, how long is this going to go on for? And in some very recent discussions, that's been starting to come up. So the initial time frame was a 3-month period. There have been some that have been longer, the 6-month period, and some of the instructions to the bankers from the Prudential Authority have been for the entire 2020 year. But most of these pay cuts have been for 3 months. So as at the end of June, we'll be coming up to the end of the 3-month period. Also, we're coming out of the level 4 lockdown with the economy opening up to some extent from the 1st of June. So people already start saying, well, does this pay cut persist and what is going to happen? And one of the poll questions that we've asked is to ask what your thoughts are. And I've given some specific dates, but please, given that it's multiple choice, do please select the date which is closest to the reality for your company. Now, that's the one cogent question that's coming up, is how long does this last for? But one of the other elements that a number of our clients have been wrestling with is the tax treatment of that, because you certainly don't want to be in a position where the taxman takes his share of the remuneration that might accrue to you, even though you might have taken a pay cut. It's quite important that you get the timing right. And if it does accrue to you and then you actually donate it after the fact of accrual to you to one of the funds, to make sure that you're getting a tax deduction for that if it's being contributed to an appropriately registered fund. So Kelly, maybe if you could come in there and just give some insights there.
Sure, Martin. So we've seen a number of ways that these sort of salary cuts, in inverted commas, have been implemented. And there are three main ways. In the first scenario, there's a pure cut. So you've just agreed upfront with an employee or a non-executive director that you're going to reduce the fee or the salary payable to them. And this one, you really need to structure properly to make sure that that is agreed and reduced to writing, preferably some kind of agreement before the accrual, so before the start of the month in which that salary or fee is earned. If that is done, then you only have to withhold PAYE in the case of an employee in respect of the reduced amount. So there is no accrual of the normal salary, only an accrual of the reduced salary. Very importantly, that needs to be implemented correctly, and the reduced amount must be taken into account then for all purposes. So for calculating bonuses, for calculating retirement fund amounts, And that's something that we get quite nervous about, is that people sometimes get a little bit confused with calculations on the pure cut. Another one, as you mentioned, is it's been quite popular to defer. So to say we're going to pay a reduced salary or reduced fee for a period of time, perhaps 3 months or 6 months, but the intention is to top up at a later stage. Now, that will depend on whether there is an unconditional top up, so we know that we will definitely pay you your full salary later on, or whether it's conditional upon certain financial criteria or other criteria being met. If it is guaranteed that you will ultimately receive your full salary, you will pay employees' tax on that full amount on the normal dates on which employees' tax will be held. It's just a timing difference as to when you're going to get that money. If it's conditional and we say we don't know, but we intend to top you up, then the employer company must only withhold PAYE or employees' tax on the lower amount, and only ultimately if there is a top up, then there will be a different employees' tax obligation to withhold on the topped up amount if and when it is paid. And then what's very popular with quite senior executives, as we've seen, is this idea of sacrifice and donate. So that can either be done by the employer company or by the employee itself or the non-executive director themselves. And again, you need to make sure that the entity you're donating to is a Section 18A organization, so that you're going to receive a deduction for that donation. So for example, the Solidarity Fund. Now, the general rule was that you were limited in terms of the amount of the deduction that you could get. As I'm sure most people know, there have been increases because of the COVID-19 crisis. So it normally was the case that the deduction could not exceed 10% of the taxpayer's taxable income. But for the 2021 tax year, donations to Section 18A organizations and COVID-19 funds may exceed that amount, provided it goes to the Solidarity Fund, a maximum of 10% of the taxpayer's taxable income for the year. So there have been some relaxations for donations in that case. What is very crucial is that these things must be implemented properly. And obviously in a panic, in a crisis of this kind, we've seen some sort of rash decisions being made or people not really understanding how to implement. And like I mentioned, whatever decision is taken, it must be implemented consistently. So if an employee's remuneration is reduced on a cost to company basis, you need to consider how it's going to impact the calculation of other benefits like retirement fund contributions, bonuses, the calculation of leave pay, etc., to avoid complications down the line.
Brilliant. Thanks, Kelly. Helen, I'm going to ask you a question just about the procedures for these, that certainly if you start having reductions of salary further down in the organization where it's not so much people voluntarily giving it up and it's actually required for the survival of the business or not doing retrenchments or those sorts of things, I would imagine that the process that you go through is very important. So maybe you could just give us some highlights of a reasonable process that you'd need to look at for that.
So the starting point is that because it's a change to term and condition of employment, your remuneration is that you need consent. So then it's how you get the consent. In a unionized environment, your starting point would be your collective agreements to see if there's any provisions that are relevant. But if that doesn't apply, then there are various mechanisms to get that consent. I mean, the most easy one is just asking employees, but as you've highlighted, that's more likely to work at a more senior level where you can just reduce that to writing via emails. Where you're looking to reduce salaries and you're unable or you think it's very unlikely that you'll get to consent, then you're getting to the more kind of drastic employment remedies, and one of those could even be a lockout, which for a lot of companies is not going to be a feasible or popular option, but that's your true power play, that you would make the demand to employees. And if they didn't agree in having referred a dispute to the CCMA after 30 days, you would lock them out until they capitulated to your demand, or you could position it as an alternative to a potential retrenchment, because there's no alternative if you don't reduce costs. So it would really depend on the environment you're in and which options you'd want to go.
I'm sure you could write a PhD thesis on that, but just thanks for that sort of heads up. I think I will take some of the Q&A questions just real time because they are relevant to the specific element. So Clinton, hi Clinton, has asked, do we regard the donations of salary as salary cuts? Concern that people confuse these, and this gives rise to mixed messages to stakeholders. Personally, I mean, I think that this is a sort of solidarity gesture. So I think you've just got to communicate it properly. So don't call it a salary cut if it's not a salary cut. You know, you can say that our non-executives or our executives have decided to donate 30% of their salary or whatever it is. So I think it's not really a salary cut because it's not permanent. And just be clear on how you communicate those things, be honest and clear. And Cornelius, again, hi Cornelius, he's asked if you set it up as a proper salary sacrifice, employee sacrifices the cut to the employer sets up a trust so that the relationship is between the employer and the trust. Is that not a safer route? Again, a bit real time, but Kelly, is that, can you respond to that, please?
Again, the implementation of salary sacrifice is key. It's not necessary to use a trust in the sense of the legal entity, but what we have seen is an implementation that sometimes the wheels fall off with people firstly not implementing the salary sacrifice properly in terms of the timing. So you need to make sure that you get agreement before an amount has accrued, and then calculating the reduced amount across all levels. So you need to be consistent. You cannot use the normal pay amount to calculate bonuses, leave, pay, retirement amounts, but say there has been a sacrifice because for 3 months they're receiving a lower salary. So you need to make sure, and it all comes down to documentation. It's things like their pay slip must reflect, if there's a reduction of a third, for example, the 66.6%, it cannot reflect the 100%, and that's where things really start to fall apart. So our preference is, if you're trying to choose between different options, salary sacrifices is not our preference because it's hard to implement. But to the main question, is a trust necessary? No, not in all circumstances. We don't necessarily recommend using a trust.
Thanks, Kelly. So I'll just touch quickly on increases. Been a lot of debate across my clients that are coming up to the increase cycle. A couple of things. So first of all, does any increase get implemented? Are increases provisionally approved but frozen until things open up or things get better? Or is there a definite decision there are going to be no increases either at the senior level, non-executive directors and executives, or throughout the company? And the South African Reward Association survey that gave some very useful insights, which was run about a month ago. And there's another version 2 about some further questions that's current at the moment that will be fed back into the public domain soon. Gave quite interesting guidance on that. We will give you the link to the actual survey. But at the time, there was a lot of uncertainty still as to what was going to happen. I think there was something like 40% were uncertain. Others were going ahead as usual, and others were freezing or even cutting. And just my observation is that it's very dependent on the sector that you're in. So if you're in one of the unfortunate sectors that is shut down for foreseeable future, like restaurants, tourism, those sorts of businesses, they're in terrible trouble. So, and are probably going to have to be retrenching. So certainly increases would be perverse. But those businesses like telcos, food retailers, essential health services, not the discretionary health services, those are firing on all cylinders plus more. So there is money in the bank, and they have, in many cases, gone ahead with increases. So it is interesting to see, whilst there has been a lot of what one client called falling on our swords to demonstrate solidarity when we were, the initial shock hit us, there is still the reality that there is a war for talent out there. We are competing for talent. The playing field has become decidedly non-level. It's very binary. Some businesses are thriving, and I see the mega dollar billionaires, the owners of the Facebooks and the Amazons have just got even richer. Whereas the ordinary solid businesses, you know, I always loved ecotourism as a business for South Africa and for Africa. Those are now, you know, absolutely dead in the water for the moment. So as I say, I think there are some going ahead, there are some frozen, there are some decreases, and it is very, very industry specific. But it's interesting to see now, a month or two in, people are starting to think about fair reward, retaining talent, and even opportunities to grab some talent from businesses that are suffering. So there's in fact been quite interesting. There's been quite a few executive movements, some in the public domain, some not yet, but it is quite interesting. Lots of flux as far as that goes. So let me talk quickly about benefits. And I mean, the general wisdom seems to be certainly keep your risk benefits. And Kelly, interesting, if you are now reducing your base salary as a permanent reduction, and are your risk benefits a percentage of that and multiples of salary, that's something you've got to be careful of. You wouldn't have the unintended consequence, particularly in these somewhat high risk times, that you forfeit some of the life insurance because you've had this reduction. And in that case, possibly keep the pay as it is and donate might be a better option. But what I want to ask Graham about is certainly in terms of retirement savings, if people have a real cash crunch, and obviously retirement savings are very important in the longer term, but is it possible, I won't talk about the advisability, I think your financial advisors must inform you about that, but is it possible from a legal and regulatory point of view to have a contribution holiday on your retirement savings?
Yeah, thanks, Martin. So we're dealing with a number of different scenarios at the moment. You know, we're clearly dealing with employees who are unable to work, unable to tender, and are not being paid. And because contributions are based on your remuneration, obviously then there's no contribution being made to retirement funds. So that's the one scenario where contributions are automatically suspended. Then we're dealing with employers who are wanting to cut remuneration, but in order to enhance take-home pay, so employees aren't suffering, are wanting to then reduce the retirement fund contributions. And then we're dealing with the third category of employer, that is one that simply cannot pay because they've got a liquidity issue or a problem. And so you'll have seen in the news some publicity around Denel not paying over its contributions towards the pension funds. So what the Financial Sector Conduct Authority did was to put out a regulation that said that the funds could all submit rule amendments to allow for a suspension of contributions during this period, and that they would then fast track the process of registering those rules. So many funds have gone ahead and allowed for contribution holidays. But it is not as simple as that, because the rule may be there that says you can have a contribution holiday, but then you've got to look at, well, what is your contractual obligation? Because you may have written your contract to create a compulsory obligation to contribute, in which event you must contribute. You may have structured your remuneration on a total cost of company basis. So if you don't pay the contribution, you must up the person's pay. So the first starting point is to look at the contract. The second thing you need to consider is this is not a time where you want your employees to lose their death and disability benefits. I think it's quite imperative that they be retained. And if your death and disability benefits are provided through a pension or retirement fund, the one thing you don't want to do is, if you don't make a contribution, is that they lose those benefits because no premium is being paid on the other side. So if you're going to suspend contributions, you must make sure that your retirement fund is going to be able to secure that premium and that benefit for those people, notwithstanding the contribution holiday. And similarly, you know, I wouldn't suggest suspending if you provide your own disability and death cover through an employer-owned policy. There, the obligation is generally on the employer to pay the premium, not on the employee. You may deduct it from the employee's remuneration, but again, I would suggest that's not an obligation you would want to lightly suspend. So essentially, look, although technically you may be able to suspend a contribution, you are entering into a kind of legal minefield in terms of contracts, rules, policies, all of that type of stuff that you need to look at very carefully before you do. The last thing you'd want to do is inadvertently allow a death benefit to lapse. Somebody dies and then they sue you because you've allowed it to lapse and you've not notified or informed people that it's lapsed. So that's what I would advise in relation
Thanks,
to that.
Graham. Good heads up. Thanks for that. Just two other questions while we're about it. Question from Stuart. If an entity goes into liquidation, what liability faces the company in respect of employees, leave pay, those sorts of things? Kelly, this is probably a corporate law question. I would presume if you don't do retrenchment type of processes before going into liquidation, are they just creditors of the company? Kelly?
Yeah, sorry. Yes, Martin, that's correct.
So if creditors are getting 3 cents in the rand, then you get 3 cents in the rand in terms of what's owed to you.
Yeah.
Okay, so that's the short and cruel aspect, and you've seen that with the SAA saga as to the timing of business rescue, people accepting retrenchment sort of packages and going into liquidation. Also approved but frozen increases. Are we seeing this being widely applied? No, this is the minority of cases. There's a lot of uncertainty, and in some cases people kick for touch and say, listen, we normally make this decision about now, but we're just deferring that 3 months down the road. The 3 months seems to be the metric thing. So it's kind of the minority at the moment. Paul, I'll take your question about LTI awards when we get to that, but yes, very, very interesting question. I'll get to that when we get to LTIs. So let's talk about short-term incentives or STIs. And I specifically, Helen, I'm going to ask you about discretion in a little bit here, and I would imagine it's a bit easier because most companies do have some kind of discretion, and just to ask you soon about just how you apply that discretion, but just hold your fire just a moment. So I think there's two things regarding short-term incentives. So in fact, probably three. The one is if your short-term incentives targets are not going to be met because of a real force majeure type of thing. Some companies have a policy whereby they adjust for anything which has got to do with something that's out of their control. So they really swing towards this must be line of sight, you're being rewarded for what you do, not what the world does to you. Others tend to take the more shareholder-centric principle, and if shareholders are in trouble, certainly the people at the top of the organization are also going to be in trouble, so they don't adjust. And we've seen that in terms of very different approaches, for example, to the Eskom disasters late in the year, the load shedding, which seems to be a disaster, which suddenly has faded from mind. But if you recall in November, December, a lot of the mines had to shut down. And again, very binary. Some made very significant production adjustments to reflect that as a sort of force majeure thing. Others said, no, that's shareholders' problem, so it's your problem as well. So quite different approaches to that, but definitely something one has to start applying one's mind to. And the other important thing is what are you going to do about targets for the next set of short-term incentives? And again, quite a bit of uncertainty regarding that. But let's just chat to Helen in terms of so let's say the STI. Because let's say you've got non-financial elements like safety, and because people aren't underground, it's extremely safe. No one's getting hurt or killed. So you get, or carbon emissions, no one's emitting any carbon. The Himalayas are in sight for the first time in 50 years. So you get inadvertent harvesting of STIs. And then you say, listen, this is ridiculous. We're out of money, we're retrenching. We are not, even if our rules suggest we should be paying, we're actually going to override those and say no bonuses for this year, as an example. So Helen, if you are allowed to apply that discretion, what guidance would you give to companies in doing that procedurally?
The first point to make is that a discretion from an employment law point of view is not an unfettered discretion. So we have a fairness-based employment system in South Africa. You have to exercise your discretion in a rational manner, in a reasonable manner, in a fair manner. As soon as you start doing it in a way that is arbitrary or malafidus or capricious, you may face an unfair labour practice claim relating to a benefit. So, for example, if you exercise your discretion in a way that you chose not to pay performance bonuses, that could be challenged by employees, and you'll need to justify that that was a fair decision. So when you look at your reason for doing it, and when you look at the outcome and you balance it up, is it fair? So that's the substantive fairness in how you exercise your discretion. You also have to exercise your discretion in a procedurally fair manner. So you need to consult you need to give the affected employees an opportunity to provide their input. That's going to look different depending on who you're consulting with your senior execs or with a bigger employee body through trade unions. It doesn't have to be an overly formal consultation process. The law doesn't stipulate how long you have to consult, but it's important to give employees an opportunity to give their input. And then what will also be very important is once you've met those hurdles, you've exercised your discretion in a reasonable, fair manner, and ideally consistently, but what will be consistent and whether it's justifiable to deviate will depend on the circumstances. And when you've consulted, as Kelly mentioned, paper trail is king. You should document very that you have consulted and the reasons for exercising your discretion in the way that you've done it, so that you have got that paper.
Yeah. Thanks, Helen. And this is maybe a good time to answer Leandri's question. She's talking about salary cuts and consent, but I think it applies to any consultative process. She's asking what constitutes consent, and that goes back to a question that Kelly, or a comment that Kelly made yesterday, is we're not going to get people to sign in blood on the dotted line, you know, in this sort of more lockdown or semi-lockdown case. Is it okay to send an email, to get an email response? What constitutes evidence of consent? So Helen, maybe just to comment on that as well.
So two things. From a procedural point of view, especially in a COVID-19 environment, we're not worried about formalistic legal documents, and you're far less likely to get that back from employees just for practical purposes, and also because they're at home and they had this legal document landed on them. It just needs to be informed consent. So you should make it clear, for example, if it's a salary reduction, when you're asking for consent, they should know from your email that you sent to them what is the impact going to be on their employee benefits. And if they're aware of that and it's informed consent by return email, just evidence. What you want is written evidence that they have agreed. There's no magic into what form that has to take.
Yeah. And Leandri's follow-up was, do you have to have a record for every individual, you know, obviously not unionized people, that indicates a consent, or is it okay to send a message, say, you know, please contact us if you have issues, and have a time period within which they must respond? Is that also acceptable?
That's kind of the poor relative, the last prize that you want to get, because you'd be relying on implied consent. So that would be, we gave you an opportunity to object and you didn't, and by that we are inferring that you have given your implied consent. So obviously you always ideally want to get express consent, hard evidence, the return email saying I agree. So it could be justifiable in the circumstances, but it's going to be very fact-based.
Yeah.
And in some cases, we are seeing clients doing that, and it's fine. In other cases, it would be less advisable. I think you're going to need to look at it on a case-by-case basis.
Okay, brilliant. And just a quick one for you, Graham. Poncho's question, is there a maximum period for a pension break, or is that all part of the contractual process that you have to go through?
Yeah, all part of what the rules provide for, but most rules that we're seeing do not have any specified period. So you can apply for as long a suspension as you actually require. There's nothing there in law that deals with it.
Okay, brilliant. Okay, then I think in terms of performance targets and disclosure of targets, this comes to both short-term incentives and long-term incentives that are very, very difficult to set out your stall for the ordinary sorts of targets. And that also talks to Paul's question, where he asks, if there's so much uncertainty regarding vesting targets, do we want to delay our annual LTI awards until later in the financial, or they do want to delay it until later in the financial year? After the AGM, RIM report won't be able to cover it. Will this be acceptable to shareholders? So this isn't a legal question, but a governance question. And just some of the other ones that I think we can give some feedback on. Is it okay to make awards and inform the participant that you will communicate the actual performance conditions later? And thirdly, is it okay to put in an award letter that these are the targets, but if things go completely pear-shaped, and you might not even be able to define what pear-shaped means, that we will retain some discretion to ex post adjust the award. So 3 questions there. I'll probably ask Kelly to give some input on question 2 and question 3. So is it okay to communicate that you will set the targets later or within a specific time period? And is it okay to retain discretion right till the death to make those adjustments?
Sure. So I think a lot of what Graham and Helen have said applies equally to this. The first place to look is always, what are the rules of your share plan? And then obviously there's a distinction between if you're a listed company governed by Schedule 14 of the JSE listings requirements, or if you're not. And so the first thing is going to be, what do the rules say? And when we prepare rules, we always draft them to be as broad as possible and to provide as much discretion as possible. So we would draft them to say that all of the detail is contained in an award or grant letter and not hard-coded in the rules. But if your rules do contain certain hard-coding provisions, it might be a little bit more difficult to make amendments. So that's the first place you're going to need to look. In principle, assuming you have broad discretion and your rules don't hard-code everything, I see no problem with saying in an award letter, I'm making an award now, in future we will communicate what are the performance criteria, or here are some indicative performance criteria, and down the road they may be amended. As Helen just mentioned, anytime you want to amend something, the general rule of thumb is you can amend so that you benefit a participant without their consent, although we would always recommend that you get some kind of recordal and you either click wrap agreement or you have them sign something or send an email to confirm that they understand the terms of it. You cannot amend to prejudice a participant's existing award without their informed consent. So most of what we're anticipating here is a beneficial amendment. We're saying we set a performance criteria. There's no way we're going to meet those hurdles. The share price is tanked. We intend to reduce the hurdle to benefit you as a participant. And that is permissible, especially in the light of obviously a pandemic and a huge crisis. The REMCO and the board would have to exercise their discretion and say, is the amendment reasonable? Are we acting to benefit the company, etc.? And there's a lot of sort of softer, not purely legal considerations that they would need to take into account in doing that.
Thanks.
And they would have to look at King 4. But yes, generally you can, subject to the rules and subject to things like the listings requirement, the Companies Act.
So getting to the more difficult question one, Paul, is will this be acceptable to shareholders? Certainly shareholders are a very broad church and have very diverse opinions. And personally, I think we are probably going to be in more trouble with shareholders this season than normal. I mean, there are a number of things that have to be done to retain employees which are not popular with shareholders and certainly don't hit the checklist. Just one of the useful documents that I've had sight of is the latest ISS, the Proxy Voting Institutional Shareholder Services Guideline, that basically say we understand there are going to be changes and rebasings and things like that to respond to the crisis. And we will look at them on a case-by-case basis. They're not saying they're acceptable, and they certainly are flagging that in-flight changes to both STIs and LTIs, they're probably going to be less happy with than prospective changes. But what they did stress, and I think that that is what answer to Paul's question is really going to be, is this is a time for very honest and frank communication with shareholders. And whatever you do, and I always say this to REMCOs and boards, do the right thing, take advice, really look deep into your heart and mind, apply your mind, as Mervyn King would say, and make a decision. That is your right and your obligation to do that. As Helen says, don't do it capriciously, apply your mind and hopefully document why you're doing it and communicate to shareholders why you are doing that. So I think if you're just delaying your annual awards and just say they delay it and we'll set them at a later time, that's probably a lower risk than making awards and then saying you'll tell the shareholders later, because then they will say, well, we haven't got the information on which to vote. So I think that is riskier, but if you communicate it, and it's the right thing to do, then that's what you've got to do. Just while we're on this subject of long-term incentives, just two heads up, if that's the right plural, that one needs to look at. The one is that if your share price has really tanked and it's dramatically below its normal long-run average, you could land up doing your normal award policy where there's a certain rand value, which is a percentage of salary that you would normally give. But when you divide that by the much, much lower share price, suddenly there's a massive number of awards. Be careful of that. We've already hit that in non-COVID times. Anglo-American PLC was a good example of that. They'd be the first to acknowledge, because they did consult with shareholders. They have made some remedial steps. A couple of years ago, I think the iron ore price tanked. The whole group had a very low share price, and then suddenly within a couple of months, obviously huge impact on local subsidiaries, the share price dramatically recovered. So they really, really got big pound or rand values. Shareholders and other stakeholders really upset. So look at that. You can either say, listen, we'll do the normal rand values, but we'll use the price of the previous grant. If that happened to be, like some of the mining companies, hugely higher than normal, that would also be a bit unfair. So one of the things we suggesting is look at the long run trend, maybe look at a 25 to 30% discount to that trend, and use an award price for calculating awards, which is no lower than that amount. So that's something to look at. The other thing, and this is where, Kelly, there's maybe going to be some unforeseen positive consequences which needs to be contemplated, is what about an industry where you have a relative total shareholder return condition, which is very popular, but half the horses in the race have been shot at the starting gate. Other ones, they haven't got a jockey anymore. They're running free and unfettered. So whereby some of the essential commodities have been going at full capacity, 100% from day one. Others, which are non-essential commodities, have been at 0, 50, only getting up to 100% now, and they're all in the same TSR group. So you might have a situation where you get stretch vesting, which is sometimes double or 1.5 the original award, purely because half the horses have been shot. Is that fair? So just put it out there. Those are some of the things that you need to think about. And I think a lot of the LTI conditions have been really hard-coded in award letters and are really contractually binding. So I think it would be, sorry, just as an amateur non-lawyer, I think that's going to be quite tricky to change. So Kelly, maybe, or let Graham, maybe you can give us a bit of an input into that. You've been quiet for a little bit.
Not much, Martin, but yeah, I mean, again, you're exercising discretions from a legal perspective. So from just purely a law perspective, it's an exercise of discretion. Helen's already mentioned the rationality that's required, the reasonableness and the fairness. So those are the kind of legal considerations that I think you need to consider.
Brilliant. Okay, so those are just some of the COVID things, and it's very difficult to be comprehensive about this, but some of the concerns that we're seeing, and we might circle back to one or two of those, particularly if there are some specific questions. So please do raise questions that the panel could answer. But what I'd like to move on to now is yes, Kelly.
Sorry, before we move on, just one more heads up that I've seen a few times, and I just wanted to put it out there. Please, if you are implementing a scheme where awards need to be exercised, check those exercise dates and check that they're not going to lapse. So much chaos is going on at the moment. It's easy to overlook. And one thing you might want to consider is if the share price is really, really bad and awards are either going to lapse or they're completely underwater, is this a time to exercise the discretion to extend an exercise date? And that's something that we've been considering. And the same considerations apply. You need to look at the rules. You need to consider if you can apply a discretion, if shareholder approval is going to be required, etc. But I would encourage everyone to go away, look at your awards, check your exercise dates, and just make sure that that's something that you're considering now.
Yeah. Sorry, just one thing I just want to alert people. The poll is closing in 5 minutes. 61% of the participants have actually answered, so that's fantastic. But if we would like as many people as possible, so please do take that poll. Just one more thing, just before we get on to Malus and Clawback. So Graham, please gird your loins for that question. With all of these things, and some very interesting debates that I've had, and certainly everybody's not in the same camp. The one thing is, even if there are adjustments to STIs and LTIs and things like Kelly mentioned, extending exercise periods, absolutely fair and reasonable to employees. And if you want to retain them and be fair to them, it's definitely something to consider. But other stakeholders and shareholders, you are really, really suffering. And it depends on what your industry is. If you do anything which is mildly magnanimous to employees in general and executives in particular, given the emotion that there is about pay gap and quantums of executive pay that Graham accuses me of dishing out with unfair largesse. Yes, there's the legal tenability, which you often can do, but one's really got to contemplate your navel in terms of what is the right thing to do. And I was saying on a Remco yesterday that you can look at recalibrating some targets and that, and trying to be fair to employees, but my gut feel is that the quantum has got to go down. In this economic climate and the amount of pain and suffering that's out there, if it's business as usual and you just rebase that you're getting the same as you would ordinarily have got, it doesn't seem right from the external stakeholders. But the counter argument, as the CEO on the call quite impassionedly put out, is that executives are working harder than ever, working miracles to get people back to a sanitized and a safe workplace. He's never seen such commitment and discretionary effort ever. So, it's going to be really interesting. And I think every board and every director is going to have to really think about this. So just getting to one of the important non-COVID issues, is this whole aspect of Malus and Clawback. So just to remind everybody, Malus is if there's a trigger event that Graham will discuss, that you forfeit awards which have not yet vested. Clawback is after the fact, you've paid, you've settled, and one of these trigger events happens, and then it's hashtag pay back the money. So Graham, maybe just a broad question, Malus and Clawback, what are you seeing? What are the immediate heads up that you would like to give the people on the call?
Sure. So Martin, what we've seen is a worldwide trend to push for the introduction of clawback clauses into share schemes. And I think it's largely stemmed from a couple of these scandals where executives have left an organization with large tranches of shares which have subsequently vested. And after their departure, you find that there's been some disaster that's been kind of looming and pending, and suddenly the share price tanks completely. And then there's been no means by which you can claw back that remuneration that you've paid to those particular executives. And there's a feeling that in that sense, share schemes were not aligned with the long-term interests of shareholders, that they were too short-term aligned, and that to bring in a longer-term alignment, you needed to introduce this notion of clawback. So all over the world, we saw clawback being implemented, and then we started seeing pressure come here. And the question was really, can clawback be implemented in the same mechanism as it's done overseas? Now, most countries align the Malus trigger events with the clawback trigger events. So your Malus trigger events are usually ones which are remedial and ones which are punitive. So your remedial ones are ones to do where there's been, for instance, a financial misstatement. So you've based an award based on incorrect financials. You subsequently find that there's been a misstatement. The award is incorrectly calculated, and there's a remedial consequence where you remedy it by aligning it with the correct financials. Similarly, the misstatement of a performance criteria, any one of the metrics as we use to measure people, if we subsequently find that that metrics was wrong, then we realign, and that way it's remedial. But in addition, with most Malus clauses, there's a punitive element. If there's misconduct by an employee that doesn't, for instance, warrant dismissal, you may want to readjust the award. If there's been a regulatory breach in particular within an organization that is unknown at the time, again, that is something that you may want to remedy, and then it becomes punitive. Similarly, non-performance, all of those are punitive. Now, the difficulty we had with aligning clawback with Malus is that we discovered that there's a funny little clause in the Basic Conditions of Employment Act, which was really there to protect workers, blue-collar workers. It wasn't there to protect executives. But it's essentially a clause that says you may not claim back any remuneration from an employee. And remuneration includes all of your awards and your benefits. They're part of remuneration. So similarly, you can't claw that back. There's one exception, and that exception is that you can claw back a remuneration if there's been an error in calculation. So it allows for clawback that is remedial, but not clawback for that is punitive. So if your clawback is remedial in the sense that it was done on an incorrect calculation because of a financial misstatement, then it's a remedial. If it's because there was a metrics that was wrongly stated, again, it's remedial. There's an error in calculation. And that way, clawback is permissible. But you can't align it strictly with your Malus trigger events. So that's the essential thing that we need to be aware of in relation to the introduction of clawback. We can do it. We've tried to give some consideration to whether there's not a broad interpretation of error of calculation. So for instance, if my chief executive was guilty of sexual harassment and I didn't know about it at the time that I allowed the award to vest, and I only subsequently discovered it, I put up an argument that had I known about it, I would have made him no award at all. So therefore, I've made an error in calculation. I think that's a very broad interpretation. I'd like to give it a shot. If anyone's got chief executives that's been sexually harassing anyone, let me know, because we do need some sort of test case. But I'd leave it over to you. But that's really where we are with it.
Oh, that's brilliant. Okay, I think there's lots of content to get through, but I see there's some very good questions as well. So I think maybe just responding to some questions from the panelists might be good. Just one question here. In terms of setting STI KPIs, what's the practice in accounting for the COVID impact? Does this provide a blank excuse right or resetting of KPIs or not? So I think I did refer to that. I think you've really got to apply your mind to it. It certainly is a valid thing to consider, but you're looking at the broad stakeholder groupings, whose rights are more important, executives and management or shareholders. So it certainly is a valid thing to discuss, and the ISS certainly it's valid. Apply your mind, do the right thing, and communicate it to shareholders. Again, Cornelius, in a very Woolies-centric question, but I think true of any business that has got a multiple portfolio, that clearly no secrets, food business in Woolies will be good, whilst fashion will be the opposite. So is it fair to give the foods people fantastic bonuses and nothing to the fashion people? Again, I think a very difficult question, and the board and the REMCO and yourself, and I presume me as well, will have to work this out in some pain and suffering. Do you look at the aggregate performance and smooth it out, normalize things a little bit less to the foods people, subsidizing the fashion people? Have the foods people been working out of their skins, facing unsafe, or not unsafe, but I mean more risky conditions than those that are working at home? Difficult question, Cornelius. And I think really this comes to good boards and sound directors and their advisors and staff for making the right decision. So sorry for kicking for touch on that one. Here's a proper legal question from Elani. A link to laundry's question. It's very difficult to get consent from employees who do not have access to emails and are at home due to lockdown. So maybe, Helen, this is something to look at. Have you come across this? Is there any remedy that you can think about? I suppose phones and WhatsApps and things like that might also be useful.
Yeah, so I mean, so the hardest employee population group to get consent from is where it's not your execs who have got the emails and the laptops, and it's not your trade unions where you're doing it by way of collective agreement and you're consulting and negotiating with representatives. And so let's think of a call center. Actually, people are having to get creative. There's designated managers in the business, and they're doing it often actually through WhatsApps. And then when they can, as businesses come in line, they're getting the agreement, and then they're getting the paperwork very, very simple, but they're getting the paperwork sorted out or kind of just more getting your ducks in a row more when people are back in work to sign. So for now, it's being practical and it's what you can get, and that may be a WhatsApp, and then ideally you supplement it with something to go in the personnel file a bit later, if you can.
Mm. And yeah, thanks for that. And Audrey has also mentioned balancing the need to adjust STR rules while taking consideration shareholders' needs. As I say, no formula for this, and a difficult question. A question about, is it reasonable to allocate back to options or SARS because the share price is low? My feeling on that one, whilst again it's a valid question, is you don't want to be cherry picking and doing just because the share prices are normally low, a SAR magnifies that. So I think shareholders might be more irritated by SARS. My question is actually, should we be looking at restricted stock, modest awards of restricted stock, and there is just an embryonic trend, certainly below the disclosed officer level, which was there even before the COVID crisis. Because we don't have performance conditions, modest amounts of restricted stock, as the US tech sector is already doing, might be something to look at, and that's a whole paradigm. But the policies of institutional investors are pretty anti that at the moment, but maybe a round table between lots of credible companies and some decent institutional investors might be useful to discuss that. And finally, just a question from Banking Head of Reward. How prevalent are prudent financial control provisions alongside Malus and Clawback, where boards decline to vest awards on the basis that the overall financial health of the organization is under pressure? So I will hand that to Graham to answer, but just a quick one. If it's a Malus type thing that they decline to vest, and those prudent control provisions were well disclosed in the rules and the award letters, I would say that's more like a performance condition where rational exercise has been, rational judgment has been made than a clawback. But Graham, I think that will be more like a punitive one than a corrective one.
Yeah. Look, it's certainly the regulatory compliance issue is very much a trigger event for Malus, because it's obviously conduct that you're trying to encourage, is that you don't have any regulatory breaches at all. So we often find them with the Malus clauses. It's more difficult with the clawback, because then it does strike me as being more a punitive one than a remedial one. It's very difficult to argue that there's an error in calculation premised on that, unless you use my very broad interpretation of, had we known, we would have given you nothing. But we yet to test that one.
Yeah, so definitely performance conditions / Malus, but very difficult on clawback. And again, one from Paul about the delayed AGM thing. It's going to be very difficult to set performance targets for LTI awards. How about issuing longer dated restricted LTIs awards with low or no performance targets? And yes, I think really this is something that I've suggested right from the beginning of this crisis. Definitely for more junior people, and probably with some consultation or even just communication. This is what we're doing. Vote against us if you want, for other companies. And I have seen that happening. The grand deal is probably lower numbers, so you've got to do a haircut, 60 to 70% of the opportunity to counter the risk. And the longer dated element, I think, does talk to more retention, longer time. And if we think about it, and this also does go with companies which have said, listen, we are going to pay no STIs, no matter what the formula says. We're going to freeze pay, we're going to give no STIs, particularly for the more senior people, but we're going to give a reasonable slug of performance shares. And that gives us an extremely compelling argument for climbing out of this hole, being with us for the duration, rewarding the really tough and difficult work that we've got to do to rebuild shareholder value. And I think that talks to our national imperative as well. We've got a debt burden of 500 billion to $1 trillion that we've probably got to pay back to somebody. This isn't going to be magic from nowhere. And it's going to be incumbent on business to work a miracle. Our president has said we're going to have to rebuild the economy in an inclusive, innovative, high growth manner. So this is going to need unprecedented cooperation between all stakeholders. And I do think we are going to need reward measures which reward positive and innovative and successful behaviors. And there is going to be a war for talent. And if we don't look after our people when international flights are available again, people might leave, and we might leave some of our critical leadership talent. So we're just about at the gong, and we turn into pumpkins. So maybe we can just share the poll. So senior executives pay, so just about 36% no pay cuts, opening up 5% 1 June, 22% 1 July, 13% 1 October, not foreseeable future, that's 15%, and none of the above. So useful stuff. Hopefully that gives people some guidance. The 3-month rule, apart from for those that have pay cuts, is interesting. Let's see if I can scroll down. So for the company LTIs, no changes to LTI award or future awards, 18% changes to future awards, 13% changes to in-flight, and a hell of a lot of uncertainty. Regarding Malus and Clawback, no above, it's 40%, only 1% of Malus only, 4% of Malus and Clawback for directors only, full 25% Malus and Clawback for directors and other executives. So if you have it, it seems to be Malus and Clawback for deeper than directors, and a whole lot of uncertain. So hopefully those people need to consult their company policies and see what the reality is there. So thank you, everybody. Thank you to my colleagues and panel delegates. Great insights there, really enjoyed that. We had up to about 240 people participating, great Q&A questions. So thanks to everybody, been very worthwhile discussion. I hope you have enjoyed it and got something interesting out of it. Thanks everybody.